Welcome to the Energy Finance and Risk Management session. Oil prices have collapsed over the past year, and market participants are redefining themselves in a lower commodity price environment. This afternoon, we are honored to have a distinguished panel of energy risk management managers and economists to discuss the events which led up to the collapse in commodity prices, implications, and what may lie ahead. We are also pleased to be presenting an interactive portion of our closing session, introducing a new technology called Poll Everywhere. In the upcoming slides, you will be presented with multiple choice questions and answers. And I encourage everyone to try with your cell phones. And before we begin, I'm required to provide the following disclosures. We are asking the audience for their personal opinions as experts active in the field, representing solely themselves and not the variety of academic, government, and business institutions they may be employed by. The results may or may not reflect the opinions of IAEE, USAEE members as a whole. Not everyone, not even the session coordinator, will be able to learn the identity of any individual respondent to the polling questions, as the responses will be tallied and the text is erased immediately by the software. Everyone should realize there is no protection from anyone trying to deliberately distort the results by giving extreme responses. The results will be publicly available along with the presentations immediately after the conference, so that anyone can share in any wisdom or competitive benefit found in these results. To participate by computer or tablet, and directions will be also provided on the following slides. You can visit pollev.com/USAEE and select your answer, or you can join by phone by texting USAEE to 22333, and you text your one-letter response to each question as they appear. You'll be able then to see real-time the updates of the responses as we receive them on the big screen above. And we ask you to please participate and have your opinions heard. And the results, by the way, of these questions will be discussed at the end during the Q&A, but the results will be tallied immediately. Okay. So we've got our first question here. Text at USAEE to 22333. And the first question is, U.S. oil and gas producers are required to value reserves biannually for reporting purposes. What is the cumulative 2015 write-down of oil and gas reserves reported by a group of 66 U.S. producers through the end of June? Wow. So are we done? No? Okay. I'm writing down the results for us. I don't know. Tell us. Does it allow you to respond twice? So, are we good to go here? right. Okay, that looks pretty good. We're good, right? Okie doke. Next question. Global energy consumption dropped in the aftermath of the credit crisis. In light of the current global economic turbulence, what is the probability that we witness a drop in oil energy consumption sometime in the next 2 years? USAEE 222333. 22333.
Which one's the ABC?
Oh, the first one is A, the one below that. It goes in sequential. Top to bottom. Harsh. Oh, hold on a minute. New technology. We'll tell you when to vote. Hold on. Oh, does it work now, Rebecca? Okay, now you can vote. Are we good then to go to the next one, Rebecca? No. Rebecca, something's wrong. We just. All right, so these aren't the real, this isn't the real tally yet.
No, it goes. It's updating now. My phone.
Rebecca's loading, hold on.
Was that supposed to be 2017? Yeah. 2035? The second number doesn't make sense. Well, second year.
20.
2025.
It should be 2025, that's a typo. Excuse me. Let me read the question to you. Currently, non-hydro renewables provide under 3% of global energy usage. What will this percentage be in 2025? 2025. Yeah, apologies. Okay, let's go on to the next one. Just hold on a second till Rebecca loads this. Okay? Hold 1 second. Oh, yes, it's A to from top. Oh, there it goes on the side. Okay, you can go ahead. Okay, next question. Tell us when we're ready to go. Hold on, hold your horses. Okay, now you can vote. Data is showing that oil demand is starting to peak in the OECD economies as a result of population demographic trends and policy intervention. What year do you think global oil demand will peak? Okay, I think we're good to go. And we're in excellent hands for this session, and it's my pleasure to introduce Amy Myers-Jaffe, who is a leading expert on global energy policy, geopolitical risk, and energy and sustainability. Jaffe serves as Executive Director for Energy and Sustainability at the University of California, Davis, with a joint appointment to the Graduate School of Management and Institute of Transportation Studies. Prior to joining UC Davis, Jaffe served as a founding director of the Energy Forum at Rice University's James A. Baker III Institute for Public Policy. Jaffe is widely published, including as co-author of Oil, Dollars, Debt, and Crises, The Global Curse of Black Gold, and co-editor of Natural Gas and Geopolitics from 1970 to 2040. She currently serves as a member of the U.S. National Petroleum Council, an advisory board member of GE Eco Imagination, and chair of the Global Agenda Council on the Future of Oil and Gas with the World Economic Forum, Davos. Jaffe was honoree for Esquire's annual 100 Bright and Brightest 2005, and holds the Excellence in Writing Prize from the International Association for Energy Economics, 1994.
So I'm going to try not to be repetitive to my lengthy question this morning. For those of you who are seeing my lengthy question this morning, kind of one of my slides is that lengthy question. So we've had a big price move. The oil industry has a new slogan, lower for longer. That's the new buzz slogan in Dallas and Houston. So I'm going to sort of address that concept, whether we're really lower for longer or whether we're just back, in our normal cycle. So, so I get that we have the shale, and therefore people say, well, it's not the normal cycle. I might argue that the shale is actually a manifestation of the normal cycle, and that the normal cycle is we have high oil prices, that causes governments to respond with new policies like the 2007 CAFE standards. It causes banking crisis, which is somewhat controversial philosophy or idea, but it seems to be highly linked. I can talk about that in Q&A. But the other thing that comes at the same time that you have this demand destruction through substitution and other forms is it stimulates, the high oil prices stimulates drilling innovations. And eventually those drilling innovations lead to a supply bubble. And if I take 2 minutes and just describe to you the one that happened in the 1980s, it was pretty clear. They had advances in deep water drilling technology. People had imagined that the production in the North Sea and other places where it was going to be used was going to happen slowly. All the banks and financial institutions in the UK decided that they could make a lot of money if they took institutional investor money and put together partnerships to contribute to drilling in deep water in the North Sea. And so therefore it accelerated the pace at which North Sea production increased. And by 1983, you had this giant buildup of North Sea production. By 84, it was becoming a big problem for OPEC, with Saudi Arabia serving as the swing producer. And guess what happened? Saudis decided that they didn't want to be the swing producer anymore. They announced they're going for a market share policy. They thought they would do this to knock out all this new offshore deep water production, which was so-called high cost. The high cost at that time, just to give you guys comparative thinking, was that Shell needed $15 for their new Auger field in the deep water Gulf of Mexico. And Yamani believed that if the Saudis brought the price down to $15 from then what was a 32 world, that they would knock out all of the North Sea and all of the Gulf of Mexico. And they went to 15, and then they went down to 8, which was sort of an overshoot. It didn't work. None of the deep water resources shut in. It never shut in. People went to their OPEX. And, we now know that the deep water story is it didn't inhibit deep water. Deep water went on to become 10 million barrels a day of production. And the Saudis eventually ended the price war because it wasn't working. So I tell that story just so you can understand that when I say, no, there's a cycle, there is a cycle, and the ability to bring shale on faster than deep water is going to be material to how the cycle unfolds, but I don't think it means we're not in a cycle anymore. So that would be sort of my view. And so to make the point, Ken Metlock and I put together this slide where you see the black line, which is the history of the mega cycle from the 80s through the 90s. And you can see how extended the down cycle is in terms of number of years. And then this red line takes us out to about 2012. Many people used to look at this slide, and nobody believed that that meant that this downturn of the red line was a downturn. And I used to say, no, look, we're about to make the downturn, right? So the question for my talk is whether the red line is going to extend out as long as last time. So how long is lower longer? So, is it short-lived? Is it structural? So I would argue that some of it is structural in the following way. Between 2002 and 2015, there were 3 main characteristics to the idea that oil prices could not go down below 70. The first one, which I used to make me just crazed, was the idea that we'd peaked in supply, there would be no drilling innovation anymore, and all the easy oil was found, all the oil in the world was found, and therefore prices were going to just stay above 100 and move slowly to 200 as we tried to finance renewable energy and electric cars. And that would just, for endlessly, prices were always going to be high. And when I tell people, just to give the historical perspective, now I'm going to date myself, when I first came into writing about oil in 80, people explained to me that, there was these things happening in the market now, and I could write about the price collapse that was coming, but that in the end, right, what I didn't understand is all the Gulf Arabs had to do is wait. Because when they would get to 2010, we would have run out of all the easy oil, and they will get their $150 or $200 forever. And we in the West will just, we'll have to pay that because all the resources will be left in the Middle East, and they'll be able to control the price. And that is what people believed in their hearts forever. So I think that what happened is we get to 2010, prices are starting to go up. People are talking the peak oil theory again. It's playing to people's unconscious prejudices when they came into the industry at 25 years old in the 1970s and 1980s. This is what they were told. And so people just glommed in and believed it, even though they knew what was happening in the shale. Like the shale started in 98, 99, 2000. Like you could see it. And like people just, no, you don't. At first it was, no, they'll never get out of the Barnett. And the second the natural gas price comes down, the Barnett will shut down. Then it was like, well, it'll only ever be natural gas. And then it was like, well, it's going to be oil, but only in North Dakota. Right? So anyway, so peak oil theory, I'm hoping that this is my ability to announce that we will never believe in peak oil theory again. Right? I mean, or at least till I'm not, when I'm gone, I can't speak to it, but at least I think in my lifetime, I'm able to say we will not hopefully come back to peak oil theory. The second thing that I used to tell people, listen, we have to deal with the China myth. The China myth was that there's so many billions of people in China, and they're all going to have a car, and they're all going to drive around, and they're all going to, be manufacturing goods that are going to be sold to everywhere else in the world, and therefore they have endless demand, and it's going to go up forever. They're never going to have a recession. They're going to be having export-led growth forever. And then if they change their mind and they don't want to have export-led growth, the lessons of Japan are they're completely immune from everything that happened to Japan or South Korea. It'll never happen to them. They're unique. They'll always have above 10% demand growth because even if they decide not to have an export-led economy, even though every other economy in the world has taken 10, 20, 30 years to convert themselves to what I call an internalized economy. I don't know what the right word for that is. In other words, where you're selling goods to yourselves, right? That the Chinese are going to be able to do that in a year. And therefore, they're not going to have a recession. Doesn't matter what happens to Europe. Doesn't matter what happens to the U.S. economy. The Chinese will miraculously be able to stop selling things to the global market and sell things to the internal market, and they'll never have a recession. Guess what? Not right. Okay, and the second one, which is my favorite one, so I'm sorry Ken's not here because I could throw up his slide, right, is that rising upstream service costs mean that the price of oil cannot go below $70 because $70 is what it costs us to produce the marginal barrel. So that brilliant idea, presume that service costs cause the oil price and not the other way around, which is that service costs follow the oil price, which is indeed what happens. And we've already seen that, with all due respect, at the expense of Schlumberger and Halliburton, because the second the price of oil went down, the first 30% of service costs came off right off the top. Within how many months? 2. Okay. So just making my point for emphasis. For those of you who don't know Bob, he's with Schlumberger, so that's why I'm asking him. Okay, so let's chart that up in a different way. Okay, so this is a chart that has the real price of oil, adjusted for inflation, which is the blue line. And the really interesting thing about looking at it over time, right, is you can see this period that I talk about from 2002 to say, 2014 or 2013 as being an aberration in what was a mean. So when the Wall Street, I know Ed Morse didn't make it here today, and I can tell you because I talked to him 2 days ago, he still believes the oil market could go down to 20, right? And I can, if you want me to, in the Q&A, I can tell you why he thinks that, even though I guess I shouldn't be doing that, but anyway, I do know why he thinks that. I'm sure he's written it. So, but if you take Wall Street's view, the official, like Goldman Sachs and all these analysts, have predicted $35 oil as being the settling point for the market. And if you just look at my analysis here, which done courtesy of one of my assistants, what you'll find is that on an inflation-adjusted basis, if the oil price would revert to the mean, that would be in today's price, that would be $33, $34. So my guess is that's all Wall Street did, is they went and looked at the mean, they decided the market's going back to the mean, and that's where they're getting their $35 prediction. So, so why am I telling you that we're going to $35 forever, which would be my, normal inclination since I believe in the cycle, and I showed you that superly long black line of how long the 80s and 90s we stayed at the down part of the cycle. And with, Schlumberger has taken this 30% hit, both in deep water and in the shales. But the companies themselves are just starting to cut costs. So I feel the costs can come down even more because people up until 6 months ago or 3 months ago were still FedExing a piece of equipment from Brazil because they needed it, and they were still having 25 people screw in a light bulb, right? So now the companies themselves, and not just the service providers, are going through the arduous task of squeezing those last dollars out of cost and having new process controls inside the companies. So, but we're having the Syrian conflict, as we know. I keep having to adjust this slide. I finally settled on the words Russian military moves have uncertain outcomes, because that way I don't have to keep changing the slide over and over and over again. But the bottom line is the Iranians and the Russians have a different strategy than the Saudis, and we heard about that this morning. If you're Saudi Arabia, UAE, Qatar, and you're trying to win this war in Syria and around the region, right? Low oil prices are your tool. We all know how much floating inventory was in the market before, but the Gulfies themselves have something like 40 million barrels of oil afloat, which they have shown to the Russians and said, if we don't like what you're doing on the ground, this 40 million barrels can come into the market. So that's pretty bearish given how the Russians are responding in Syria. And so normally I would say, like Ed, oh geez, $20. But the reason that I don't say $20 is because if you're the Russians and the Iranians, your response to that is, well, you know what, we're going to send some missiles to Yemen, because it's Yemen the United States won't respond. That is going to cause a reaction in the oil market, which we already saw when the first Yemen things happened. Price of oil went back up to 60, right? And so this military activity, quote unquote, helps keep the price of oil from falling. And is, in my opinion, the reason why the market's stuck, right? Because if the Saudis didn't have 40 million barrels of oil in storage on the water, and it was just that we had a few inventories at Cushing, the fact that the Russians and the Iranians are willing to take a military action to escalate the violence, would have a real terror premium. So as I was saying to my fellow panelists, I might argue in a way that I absolutely cannot quantify it, right? That, so maybe that's my next paper, right? That we carried about a $10 a barrel terror premium. If the first slide, if this slide is correct, we're still carrying a $10 terror premium. That would explain why we're at 45 instead of 35, right? And so, as I talked about this morning in the Q&A, you have these different things that are happening in the market that would be the piece of what would take us, assuming that we don't have a further collapse in the global economy, because then of course we are going to go down, right? But if the global economy has any kind of stability and then returns to some growth path, here's the list of all the different reasons why we could have a supply hole reemerging in the market sometime in the 2 to 5 year period. And then I think that would build the seeds for the next cycle downturn, which again I can talk about, because then we're going to start to get to a period where, given your poll, people are going to start worrying about peak demand, and you're going to start to get, which you're already kind of seeing a little bit, some decapitalization of whatever it is that's in the resource base that people believe or don't believe could be stranded, right? So there's going to be some competition to make sure that my reserves are not the reserves that get stranded, especially to the extent that we start to see more progress on a global climate agreement, right? You're going to see the markets start to anticipate which reserves might be the reserves that get stranded. And you might see people playing that out and thinking about their next tranche of investments in the Arctic and the oil sands. So, with that, I leave it to my next panelist.
Next up is Dr. Glen Swindle, who has held senior positions at Constellation Energy and at Credit Suisse, where he was managing director and co-head of power and natural gas trading. Previously, he held tenured positions at UCSB and Cornell University. He currently holds an adjunct faculty position at New York University, where he lectures on energy valuation and portfolio management. He is also on the Energy Oversight Committee for GARP's Energy Risk Professional Program. He is the author of Valuation and Risk Management in Energy Markets. He holds a PhD in Applied Mathematics from Cornell University, an MSE in Mechanical Aerospace Engineering from Princeton, and a BS in Mechanical Engineering from Caltech.
Thanks, Tina. Pleasure to be here. I'm honored. The forecasting and trading and risk management are intimately related activities, and the sort of the flavor of this panel became partly forecasting insofar as the questions you are being asked to opine upon at the beginning of this event. And so what I wanted to do was start by doing a sort of a market data-oriented view of events that might motivate your forecasts, as well as probably throw a big pillar of salt on the idea of making forecasts at all in many ways. A human being can only go to so many talks at an event like this with all the sessions, but if I were to summarize and basically say that the summary is lots of stuff has been happening in the energy markets, and it's really interesting. The stuff started, I mean, it's been going on forever and ever, really, but I've listed some of them here. And interestingly, I note that I didn't include geopolitical uncertainty, which is quite a gaffe if you think about it, given that it's central. But one topic that I haven't seen covered too much, and what I'll transition to near the end of this, is the impact both of the chaos, all these dislocations in energy markets, coupled with the regulatory induced drop in liquidity. And that actually affects your ability to get the billions of dollars you need to build the combined cycles or the solar or the wind. And I'll talk a little bit about what we're seeing when we work with PE shops and lending banks on that. Now, this is likely, this series probably likely to cause eyeballs to glaze over because it's been up so many times, but let's start with Brent. I'm going to walk through it, but again from a slightly different perspective, and hopefully it'll be interesting and enough at variance to keep people awake. The topic, well, let's just step through this right now. The name Ed Morris keeps coming up again. We're just talking about him, and he was supposed to be on the panel earlier, but in the first phase, the lightly shaded gray period, you know, it's easy to look back and say, that was crazy. And I think Ed, sometime near the end of that gray period, published oil.com, where he said, this is a bubble. But that wasn't universally accepted. And in fact, there are no number of good explanations why it could just continue. Moreover, traders were putting their money where their mouth was by transacting $200 call options on crude oil. So there was a belief among certainly some people that it wasn't insane viewed from the perspective of the gray box. Now, again, forecasts being what they are, it's but a few short months later that it's a complete catastrophe. As mentioned earlier, huge sell-off. There were tankers storing oil. You could earn over 200%, not net of tanker fees, but you could earn a lot of money just by storing it. And there was actually, as most people know, real drops in demand globally. Even global electricity consumption dropped. But I wanted to go to another picture here, which shows you sort of in our wheelhouse, namely in the power markets in the East, what it really looked like from the perspective of walking into 2009. This is, I'll just focus on the bottom of the moment, but imagine, as we were doing and many places were, you're trying to figure out how much electricity is going to be consumed because it underpins your swaps that you've written, or for utility it underpins your load, and you really care about that. It's how much you should hedge. So you're cruising along and you stop in mid-2008 and you had your best models, the best thing you can come up with. It's calibrated, it's just loaded, you're pumped, it's all good. And then you feed realized temperature and all the stuff through it, and you ask, how did it perform during that period? And you can see the residuals down there. It's absolutely a bloodbath, like a 10% reduction in electricity demand, which wreaked untold havoc on people. And the reason I emphasize this is that if I look at the geopolitical comments made and other things, if you transition to the next epoch, lots of stuff, lots of stimulus, basically an ongoing, very low interest rate environment, an enormous amount of QE, and all that's really happened. Again, economists might howl at me, but from a novice, a layman's perspective, looking at economic data, it certainly appears that the deck is basically, the chairs have been shuffled on the deck. That basically, household debt may have gone down, but corporates are buying back equity and borrowing to do so, and sovereign debt's much higher. So ultimately, the global leverage of the economy hasn't, certainly it appeared to me, hasn't really done very much. And it's almost as if you could imagine, going backwards, you shouldn't forget what could have happened if you get a redux of this in the next year or two. Hence the motivation for that question about reduction in energy consumption in the next 2 years. It would seem possible. Now, this is the part that we've been focusing on largely around the conference, as far as I could tell, namely what's been happening lately with the big sell-off. And being sort of a data geek and as opposed to sort of a fundamentals person, one way to look at this price collapse, the recent one versus the previous one, is via the way equity markets responded to it. And we'll talk about equities in one more slide in a moment too. But XLE is just a broad-based energy ETF, sort of everything from Exxon to Schlumberger to all the way down the food chain, a big pile of them constructed in some way and traded, quite a liquid instrument. And if you look at the period from the top graph, for those in back, it's probably hard to see, of 05 to 2010, and you strip out S&P, just say let's regress it out, some plain old-fashioned regression, and plot the residuals against the front month Brent price, you see something interesting. You see, as the top figure, you see how during the worst of the credit crisis, energy markets overperformed. Everyone was flying to quality in some way. I don't really know why, maybe people do. But it could have been they say, well, I just like oil in the ground that Exxon has, that's tangible, that's what I want. But any way it goes, it was clearly, in the greater scheme of things, a relatively good day for energy equities, whereas in the bottom plot, it's unambiguously not. As oil prices plunged, it went right down with them. And so the two price sell-offs, viewed purely from an econometric perspective on equity prices, were fundamentally different. Now, we had a question on renewables up there, and if you just randomly pick one, like Solar City is the one I picked, and you do the same thing against natural gas prices, rolling CalStrip to get rid of seasonality and all that stuff, you see it's also a bloodbath for renewables, at least on the solar side. As Brent has gone down, or this is natural gas, has gone down, their equity price goes down. The markets certainly are ascribing a less bullish view on your ability to pursue the renewables dream in a low energy price environment. Finally, just a couple more slides, and then I'll turn it over to Michael. Not all commodities have been responding the same way. And while Brent and oil has been the central topic of the panel in many respects broadly, if you look domestically here against 4 series, all normalized to 1, you can see that natural gas and power have their own attributes that are largely, or in many ways, decoupled from oil and coal. And so the details aside, the moral of the story is you begin to realize from a funding perspective or a trading perspective, it's now going to bifurcate into a bunch of different commodities, all having a structural sell-off and all driven by different factors. Now, one last one to add to the dimensionality. TETCO M3 is among natural gas traders a place right up around here, sort of the New York area, nice, cold, heating, all that. And the impact of shale gas, which has been talked about a lot, has driven forward curves. This is the top one. The green one is up here where it's cold. The blue one's down there in Louisiana, otherwise known as NYMEX, has driven one that was always uniformly and ubiquitously discussed as premium to substantially discount over large periods of the year, wreaking havoc on a lot of hedging programs. Second of all, if the polar vortices hadn't occurred, those peaks in the winter that are there now would be a lot lower. So everything has been changing, the entire dynamics of the way commodities prices are behaving, and it affects how you actually manage risk and fund assets. Now, if I go to, this is now just a placeholder picture, I would put something up that I'm not allowed to, it turns out, which is a screenshot of an ICE trading screen. ICE is a big exchange that all the traders trade through. It's very convenient. Clearing occurs. It's everything that the regulators would want. And you can take a screenshot now or even back a year ago, and you will see in the power markets liquidity in the most liquid of the liquid locations in 2018 or 19, only a couple years out. Back in the day, before the credit crisis and before Dodd-Frank and everything, you would see liquidity extending out 10 or 12 years. So it's simply crunched. The amount of stuff you can legitimately trade if you're intermediating commodity risk has the dimensionality of that has gone down. But if you look back at this picture, M3, and for every M3 there are many gas locations and even more power locations, the dimensionality of the risk that you're having to make investment decisions on and hedge around has stayed as big as ever. So you're caught in this nutcracker where you only have a few chopsticks and you have a whole lot of things you have to try to control. Now, I'll conclude by saying that this is the topic that, again, I think is really frontline and center in many of the ongoing trends in commodities markets and infrastructure. And that is how asset finance occurs. And again, probably many people know this, but I want to emphasize it because it is definitely showing problems. When you go and say, I want to build a combined cycle generator, give me the $700 million of borrowing I need. The lender, or usually a bunch of them, says, well, I'm not an idiot, I'll lend you the money, but you better be hedged for a while. Because I know, and this is the top picture there, that if I lend you the money, you have a random set of cash flows. Could be, there's going to be another new technology that blows the world up. Could be a geopolitical event, completely changes things. I know it's random, and I don't want you to default on it. So the way it works is the lenders say to the borrower who wants to build the good thing for the world, I need a hedge. So they go to one of the dealers, banks, or it could be a bunch of BP, Shells, a lot of the big participants, and they structure a hedge. And that hedge is for a shorter period of time than the asset life, and it's designed to annuitize the value of the asset so you don't default. Now, the problem is that when you're going to dealers now and asking them for hedges, which you need because otherwise it's hard to get the loan, the response is, I'm full up, I can't do anymore. So immediately the set of dealers goes down. And then if those still standing, they'll say, well, I'm not doing it at TETCO M3, or I'm not doing it where you have your unit, I'm doing it at this hub because I can only barely trade that. The point is you're getting a mismatch between an increasing difficulty in structuring hedges that actually support the financing of all these good things that people are talking about. And that is explicitly due to the fact that liquidity has been collapsing at the locational level. So the two themes are, one, it's hard to hedge with project finance, and finally, it's hard to predict stuff. I'm ending with this one, back to the prediction. Same series you saw. The blue is the Brent contract. The colored lines were the forward curves at each moment that was plotted. And you can certainly say one thing is for sure. Now, forward curves are really kind of a yield curve. I'm being a little disingenuous here, but a lot of people look at the forward curve and say, gee, that's the market's forecast of where it's going to be. You can certainly conclude, don't put a lot of credence on it because it's not a terribly useful predictor when it comes to answering questions like we were just talking about here earlier. So Thank you very much.
Okay, next up is Michael Sell, who is Senior Vice President and Program Manager for Global Association of Risk Professionals, GARP, Energy Risk Professional Global Certification Program. Michael has more than 15 years experience in risk management and fixed income structured product development and management. Prior to joining GARP, he was the operating officer of Anchor Capital Group, an investment advisor for tax-exempt investment funds. Prior to his work at Anchor, he was vice president and credit officer at Citigroup, where he was part of a team that managed a multi-billion-dollar portfolio of structured, tax-exempt products. Michael earned a BS in Finance from Miami University of Ohio and an MBA from New York University.
All right, so thanks a lot, Tina. I appreciate that, and I appreciate being here. Thanks for the invite from the IAEE, and I just want to say that, the limited time I've been at the conference and had some interactions with all of you folks, I'm very impressed by the diverse interests you all have and the content that was delivered in the presentation. It's really been a great experience, and hope to be a part of this in the future.